Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is September 27th edition of Market Outlook. Don't forget to sign up and get both the text and the video version free every week delivered to your inbox by going to www.marketgauge.com. All right, quite a busy week with all the news. Oh my God, to keep track of it and all the cross currents is a full-time job just in that alone. Anyway, let's go to see what impact all the net effect of all that news out there is. First of all, S&P 500, the spiders, as you can see, still under incredible pressure. It was down for the week. We tried to mount a rally as of the close on earlier after Yellen announced her decision, and the market has promptly sold off. We tried to mount a rally on Friday and really couldn't get any momentum going. However, we are now trading within the Bollinger Bands, and they're certainly tightening. Nonetheless, we are in a bearish phase. The trend is clearly down for the moment. Taking a look at volume, pretty indecisive over the last 2 or 3 weeks. We've had a couple of distribution days and no really great accumulation days, and that's what we consider where the volume exceeds the prior days above the 50-day moving average of volume. We did get 2 marginal ones, so I would say the volume is sort of indecisive. Clearly, on the down days, you can see excessive volume across the board. So with the acceleration to the downside of the moving averages, market still under pressure. Let's take a look at another index as well, IWM. And you can see, interestingly, that index is under the most pressure and actually closest to the low that was put in late August on the 24th and the 25th, although we are trading above it. But nonetheless, tremendous pressure on the smaller to mid-cap stocks, and that's trading closer to the lows. Seems pretty clear that we are going to get a test, and we definitely want to watch this IWM, because if we really start closing down underneath these lows here, it could add additional pressure to the spiders as well. And again, just going back here, the critical number to look at is really these the lows put in after that panic low, and there was some trouble with reporting. So we definitely want to look at around the 187 level. The 187 level was the low after the flash crash in August. So that is a critical level to hold. We start closing under there, we're going to be in additional trouble. So that's it. Let's take a look at some of the market internals. As you can see, the McClellan oscillator, which looks out over the next couple of weeks, still on a sell signal. It was confirmed in terms of advanced declines, still very, very weak. That's the lower chart here. You can see the red line is sort of running rich, but we like to see it confirm and pull down under it after touching above it, which it did do. Interestingly enough, advanced declines are still sufficiently weak enough where you couldn't even generate that overbought signal and then a sell signal. So the market internally still under pressure. Taking a look at sentiment, looking at short-term versus longer-term volatility, this is the key chart to watch. This is extreme bearishness, or these levels that were hit after the crash, and this is the relative overzealous on the short side level. We seem to be holding there. What we would like to see for a potential rally would be a move back over this green 200-day, 200 period moving average, but nonetheless, that is still under. So we're starting to move up. That sentiment is being alleviated. the super negative sentiment, still on the negative side, but coming above it. So I would give this a slightly positive rating because we are over that absolute blue, which is the overzealous on the downside level. But we need to hold that above there. Otherwise, we can easily get another thrust down. So I would give sentiment a bit more of a positive, recovering from the oversold condition. Let's take a look at a couple of other charts. We looked at IWM. That could be a lead indicator. Let's take a look at IBB because that has really pushed the markets and the averages down. Lots of pressure. Now, what's interesting to note is you can see on the crash day, the opening, right, was above where it closed on Friday. So that's showing extreme pressure. There are very, very few instruments out there where that flash crash on that Monday, the current close this week has exceeded that lower opening and in this case, IBB, the biotech, under tremendous pressure. And you can see you had a really nice recovery. You actually got back into a recovery phase here. Excuse me, a warning phase. But again, look at that moving average, the 50-day pointing down sharply. This market is definitely under pressure. It'll be interesting. It is oversold. Wouldn't be surprised to see a bounce, but there's some real damage done. And my text sort of reveals that there are some structural issues that have been revealed as a result of that publicity of the hedge fund manager running a pharma company and jacking up the prices. So there are some structural issues in the pharma industry that have to be dealt with. Meanwhile, trend looks pretty strongly down, but we are in oversold territory, so we could see what we would call potentially a dead cat bounce here. But the leadership certainly that this industry exhibited throughout the last several years is now no longer there. All right, let's take a look at Germany. And you can see the net effect of one of the most critical industries, the leading industry in Germany, the auto industry, under tremendous pressure. You can see that it affected, obviously, the whole German stock market. It's trading on the lows, much lower than the lows back in October of 2014, with massive gaps. So the German economy definitely going to be under pressure. It's going to be interesting to see how things iron out over there and what happens with VW. And that's really going to be a harbinger of possible impact on the overall German economy and potentially on the EU itself, as there could be other systemic problems in the auto industry throughout Europe as well. One last thing I want to cover is what is interesting too, adding a little bit more credence that the flight to alternate assets, such as gold, looks pretty strong here. In fact, on our proprietary trend strength indicator, it's actually picked up quite a bit as the market has moved up while the equities markets throughout the world have moved down. In fact, most of the equity markets, in fact, I think all equity markets throughout the world are net negative on a 6-month, 3-month, and virtually everything on a yearly basis. Year to date is down on the year. So there's tremendous pressure overall on the equities markets. And interestingly enough, what's happening here in gold is you are going through a flattening of the 50. We moved into a recovery phase as the price moves above the 50-day moving average, which is trading still below the 200. That demonstrates a recovery phase. And as you can see, we're not overbought or oversold, so there's plenty of room to move. This is the RSI, not particularly in any overbought or oversold condition. We did have some massive buying over the last couple of days in the gold market. Just 2 days ago, on that huge gap up, it was up about $20 or $25. So another couple days of strength could trigger a buy signal on some of our other services, our premium services. If you're interested, that is the ETF complete portfolio, or the sector portfolio, where we do track individual sectors. Gold definitely on our radar here, and interesting, you can see that the 10-day moving average moving up sharply. So flight to alternate assets like gold amongst this sell-off in the equities markets, and this sideways to down action that has persisted over the last couple of weeks as well. All right, well, that's it for now. Hope this helps. Stay frosty. As I pointed out, there's lots of cross currents going on. You do have that longer term 7.5-year cycle, presidential cycle. You've got some conflicting ideas potentially, as the market internals are a bit oversold. Some of the market sentiment indicators also indicating that it had been oversold, possibly stabilizing, and the October through end of year time frame is starting to come upon us, which is generally favorable, except when it's not, it's really bad. So you've got some really dicey situations, and you can see that smart money can have opinions on both sides here. So you're getting this constant huge gap in volatility, which is consistent with the conflicting statistics that I just pointed out. Thanks, and bye for now.